fair market. Got it. All right, so before I start, I just wanted to show you, someone asked a question about the new CPA exam that you guys are going to be taking. So that, just thought I'd let you know that a lot of what we do in intermediate is going to bring you to the level that you should be at. So just to let you know clearly that if you just memorize something, you'll only get through 20% of the exam. So memorization, remembering and understanding only gets you 20%. What we're doing in this course is more application and a little bit of analysis. So the bulk of the exam now in almost all of the categories is application, and memorization is only data auditing because that's a bunch of rules, but that's what the new exam looks like. So what they're trying to do is bring the exam to what they call higher order learning, or higher level learning, so that you just don't memorize. And once you know the facts and once you know the standards, you have to apply them and do an analysis. And then in order to do an evaluation, we respect the quality of the, we just thought, show you on that, there's something someone had asked me about the new exam. That's how it's going to change. It's changing to moving away from just plain old knowledge and memorization to more application. All right. Now, speaking of application, we're going to now move to another example of accounting for bad debt. So if you go to module 9.2, page 6, then we go to module 9.5. We already did 9.3 on notes receivable. 9.4 we may get back to. You probably will see that also in planned assets and intermediate use. We're really not skipping that. But now we're going to use the age trial balance of accounts receivable, which is a balance sheet approach to estimate the level of bad debt. So what I want to do is put the T accounts up here. This is the allowance for uncollectible accounts, the allowance for bad debts, the allowance for doubtful accounts, and sometimes called. Got 10,000 in accounts receivable and a 170 credit balance in the allowance for bad debts. Now, let me remind you that when you deal with the balance sheet methods, that is either the aging or the percentage of receivables, you've got to know what's in the allowance account. Remember, the model or the theory is that balance sheet approaches focus on or directly focused on proper balance sheet valuation and the net realizable value or the cash realizable value of the receivable. We don't worry as much about the bad debt expense because that is an indirect result of the journal entry that we make. So the journal entry is focused on properly valuing the balance sheet, not worrying as much about the income statement. So your focus is balance sheet, you trade off or you kind of give up the direct association or matching. Now, the age trial balance looks like this. You are given an aging category. How old is the receivable? Is it current? Is it 30 days past due, 60 days past due, 90, and so on? Based on past experience, we provision or we provide for the allowance based on those percentages. So that 1% of current accounts are expected to be uncollectible. 5% of 30-day past due accounts are expected to be uncollectible. 15% of the 60-day, 30% of the 90, and all of the 120 past due accounts are expected to be uncollectible. Now, you've got 10,000 in receivables. You'd have to be given this information, whether it's on the exam or at an actual client. The 10,000 in receivables, which you see here, is aged. It's made up of different customers, and it's made up of different transactions.
100% a rational number.
100% of the, of the 120. Yeah, we're going to assume you're not going to collect any bills. And typically, I think I was mentioning that, I know my clients would send those out to an attorney after 90 days anyway. So that's our assumption. That's based on past experience.
To collection.
Yeah, to collection, right. So we assume that based on experience, and the auditors could do this, the client could do it, but you're going to be getting those numbers from the client. I mean, this could be, you know, you'd have to drill down on a screen, you know, hundreds of pages of receivables, but you get the summary. So customer A has 2 transactions, or maybe more than 2, but the balances are 30 days and 90. Customer B has a current transaction, or a set of current transactions. C has 30, 60, and customer D has 90 and 120 days overdue. So that makes up the 10,000. When you use the aging, you apply the percentages. If you've seen some of the homeworks, I'm sure you were able to do this. You take the percentage, multiply it against the aging category. I did this on the video Sunday also that I posted. Gave you another example that I just put together quickly. So $30 of the current, 55 of the 30, 435 of the 60, 750 of the 90, and 500 of the 120 overdue we expect to be uncollectible. So that means the allowance account expected to cover those losses would be $17.70. Now, when you have the balance sheet approach, that is not your adjustment. So the other way to look at this, you got a target balance. That's the balance you need, the balance you want to have in that account. 1770 is the target balance. But you've got an existing credit balance in there, so therefore you don't need the full amount. You just need a $1,600 adjustment. So you can solve for the adjustment by plugging the account, or using the formula, allowance needed or target balance less than existing credit. We'll talk about a debit in a second. And you got the adjustment. Now the adjustment, of course, debits the bad debt expense, credits the allowance account for 1006. And here's your adjusting entry. Bad debt expense is forced, in a sense, or indirectly computed in order to get the allowance that you need. The allowance is the account you want properly valued. Yes?
What's the allowance already given?
That's given. Yeah, that's the balance. So this is what you're starting with. This is your existing balance. Okay. And this is your balance. So that's the existing balance in that account. Now, the net realizable value is $82.30. That's the cash realizable or net realizable value. Accounts receivable minus the allowance. So that's the balance. Any questions on the allowance method using the age trial balance so far? Yeah.
How do you get $900 in 60 days? $30 in 9 days?
Let me see if I did that wrong. Have a mistake here?
No, I'm just asking you. It's like, how do you have?
Oh, those are given. Yeah, those are given. Those are given. So it's, for example, where, do the numbers have some logic? Here's an example of reasoning this out. So you've got a customer that you generally sell to, and they got one account they didn't pay, so you take a chance and you sell again, and they're still not paying. You notice this customer pretty much stopped selling to them now, right? Because their accounts are getting too old, and you're gonna have to negotiate with them before we extend any more credit. This could be through, due to a circumstance that they're explaining to us, and we're letting them buy more merchandise, so, they haven't done anything yet, but, so those have to be given. Those come from, so if you're at a client, the client's information system will dump those receivables and categorize them for you. Now, the CPA firm is gonna have access to the database, and they will do the tests of the database to make sure that the numbers are correct, so they have to check the integrity. You will also check the integrity of those numbers by doing confirmations. So you would send customer A a letter or an email or some kind of correspondence asking them to confirm their balance.
It could also be that the
I'm sorry?
transaction. It could also be that the transaction happened at a time where they were both current. And
Oh,
they just
yeah.
wanted to.
Yeah, so the aging, that's another thing we do, we talk about analysis, that's when we look at the CPA exam with respect to analysis. What if I gave you that aging the month before, or the year before? The aging could be sliding. So in other words, if your accounts are becoming more and more past due, you gotta talk to your client about their credit policies, right? So let's take this question, it's a really good point, that this aging is the snapshot right now. But as an auditor, you're gonna be looking at the aging over time and comparing it. So one of the things we would do is compare it and tell the client, hey, you know what? Your accounts are now becoming more on the overdue side. They're sliding to the end of that aging, the 120, the 90, and the 60. So something's happening with your credit policy, something's happening with your customers, they're just not paying. So you may have to step up your credit policy or actually change the way you bring in new customers. Like, so don't forget, one of the things that we look at in auditing is internal control. And we look at the client's internal control with respect to their credit granting. Are they giving credit too easily? If that's what's causing the aging to slide negative in the negative territory. So you're going to be given this, and you're also, just taking this from an auditing perspective, you're going to be looking at a comparative as well. All right, good question. So that's moving us more into an analysis of this, but that's a good point. All right, so any other questions? All right, so let's go to, for example, exam question B, part B, scenario B. I'm going to now change the assumption. So instead of having an existing credit balance of 170, I'm now going to tell you started the adjustment by having a debit balance of 200. What do you do? How much is the adjustment? You can do one of two things. You could plug the allowance account, or what would happen here? Instead of an existing credit balance, you would be adding an existing debit balance. So instead of having this as less, and I'm going to put that back so I make sure I don't change it too much, I would add an existing debit balance now. And that would be adding 200. And this would be 1970. So now, by changing the assumption, my adjustment's 1970. And this now becomes to make the entry. Oops. 70, 97. So, getting back to lots of questions I'm having. What do you mean by forcing the expense? Well, by trying to reach a target balance of 1770, what happened to the expense under my second assumption, the scenario B? The expense went up to 1970. What happens to the allowance account? It stays at 1770. What happens to the net realizable value? It stays at 8230. So to achieve the allowance at the level you want, to get the balance sheet focus, the direct balance sheet focus achieved, you force or indirectly affect the income statement. And that's what it is. So any questions on that notion? Now remember, the income statement approach, we didn't care what was in the allowance, we just said 2% of sales, and that's it. Now you gotta remember, in practice, let's talk about auditing. What happens in practice? Do you ever see these percentages? Yeah, you do. We do use an aging, but we would also do specific reviews of accounts. So we go in and look at customer D, and we would take a look at that customer's credit worthiness, we look at that customer's financial position, cash flows, we would make sure that that account or that customer was capable of paying. We'd also look at industry trends, we'd look at economic trends or forecasts, so, and industry information. So we consider a lot of things, not just the numbers. So these are really starting points. I mean, in a classroom environment, you can't do much more, but it is, in fact, going to be analyzed with much more depth. All right, so we would do a specific review of those accounts. All right, so any questions on the age trial balance? You would not have to put an aging together. You may have to apply the percentages against the aging, but I was just looking at some CPA simulations yesterday, and that's basically what we do. You get an Excel spreadsheet. Sometimes you got to put the accounts in the category, but the more important thing is to hit them by the percentages. All right, now, before I bring back the original numbers, any questions on the second scenario, with the change in assumption? Everyone clear when we say that the income statement methods focus on direct association and matching and force the allowance, so you don't really care what's in the allowance account or what's on the balance sheet as much as you do with the income statement. On the balance sheet methods, your concern is directly to have the allowance at a certain level, to have net realizable value at a certain level, and it doesn't really focus as much on the income statement. Now, this idea of income statement and balance sheet focus will carry through everything you do in accounting, whether it's inventory, whether it's depreciation methods, whether it's leases, any other, or deferred income taxes. You're going to find out whether or not the standards have a balance sheet or an income statement focus. And as I said, right now we're in an era, and the most recent trends, as you read in the first couple of chapters, are balance sheet emphasis. That's what we're looking at now as accountants. We're not looking as much as the income statement. Prior cycle, or the prior trend, was income smoothing, was to try to make sure that income was easy to predict, easy to project, give it more predictability. That was the older standards. So now we're looking more at the valuation. All right, so anything else on this before I put back the old numbers? So we'll bring that back. All right. Now, just one other point here. I'm going to say a little bit about IFRS. Percentage of receivables is the same notion as the aging. The only difference is that you apply a single percentage against the entire receivable balance. So I would tell you that, for example, this customer, or this client, would estimate bad debts to be 2% of the receivable balance, with a receivable balance of $10,000. And starting again with our original balance of $170. So starting with our original balance of $170, we now say that we need an allowance of $2,000. So now the target balance becomes $2,000. And the target allowance becomes $2,000. The target NRV becomes 8. So based on the existing credit balance, the adjustment we need is 1830. So once again, the expense is forced to get the allowance balance that we're looking for. So you debit bad debt expense, and you credit the allowance for uncollectible accounts. And finally, you've got a summary that you can use to study the theory, the concepts that relate to this application. So, any questions on receivables at this point? So I got 2 questions for you that I want you to look at. Let's get the, just want to see where we are with this, and then this will help you. We're not going to do anything, I will give you the solutions to everything in chapter 9, but I'd like you to do number 4, 5, and 6 together. And just want to let you know that the terminology here, cash realizable value, is the same as net realizable value. All right, so these are sample type questions that you see on the CPA. So let me get the clock going. We'll give you 3 minutes on this one. All right. This is why we ask the question. This is why we play the game. All right, so we've got a mixed result. Let me see, let's work this through together. All right, so again, that's why we ask the questions. So here we go. We've got the data as given. What's your opening balance of accounts receivable? 125. And is there a balance in the allowance account? Yes, what, 1,200? It is a credit balance, correct? All right, so now we're told that the company uses the percentage of credit sales, correct? All right, so let's see what that's going to look like. We got net credit sales of how much? 700. All right, 700,000. 2% bad debt. 700, I'm sorry, 700,000. All right, 700,000. 2%, 14,000. Question is, this is gonna, I think, drive it home. Question is that the adjustment, or is that the balance you want in the balance account?
That's my adjustment.
Next.
Net realizable value.
That's
It's
the
the
balance.
adjustment. It's the adjustment.
It's an adjustment.
It's the adjustment. So when you use the percentage of credit sales, That's the adjustment. So what you want is debit the bad debt expense and credit the allowance.
Right.
So the entry, this is an income statement approach. You don't look at the allowance account. When it's an income statement approach, you do not look at the allowance. Bad debt expense, machine, allowance, 14. That's the adjusting entry. And when we put that in, you get 15,200 as the balance. That is not a target balance. That is not a target balance. That is the balance. So what's the NRV? 125 minus 15.2, so what do we get? 109.8. Now again, I'm not getting graded on these, but I'm just keeping track, and that's what we need to do. Yes?
So how do you know which method you use?
You're given the method here. It tells you that they are using a percentage of sales method. Well, I could have given you an agent. I could have given you a percentage of receivables. There's a difference. Percentage of sales versus percentage of receivables. If this was percentage of receivables, then it would have been a balance sheet approach. Then you would have needed, then you would have deducted the existing balance, 1,200.
I'm still confused about what makes the
What's that?
percent of net sales as adjustment.
The percentage of net sales is an income statement approach. The number you get is the amount of your adjustment. You don't look at the allowance account when it's the percentage of sales. Because the focus is what? The focus is expense. What do you give up? What do you trade off? What do you indirectly affect? The allowance and the NRV. So you're not concerned with the cash realizable value.
So it's the other way around. So aging is the other way around.
Yeah, aging and percentage of receivables is absolutely different. Now, is this going to come back again? Yeah. You know how many times you're going to see estimates that require a balance sheet focus and you need to know what's in the existing account? It's going to happen a lot, not just this course, all the way through. So this is just the start of your sort of training in thinking about how do I approach the adjustment. All right, let's do another one. Anyone else on this one before we go back? And again, this is exactly why I'm using these questions, because whether they count for your grade or not, I still posted the Blackboard, but for me, that was an absolutely perfect picture. All the colors were lit up, and we had a mixed group, and it showed me we needed to do that again. All right, anything else? All right, let's go to the next one. See what happens here. Same copy. Different numbers. I think same numbers, but we're looking for. Oh no, this one we don't have to do because it's going to ask you for. Oh no, yeah, it changes something. It does. All right, this changes. This is perfect. It changes it. Make sure I caught that to a debit balance. So let's start it again. Same numbers, but now you got an existing debit balance in there. All right, so, yep, has everyone got that? Perfect. So what will happen now is everything's the same. You don't have a target balance because it's the income statement approach. This is your adjustment. And the adjustment does not consider a target balance because it's an income statement methodology. So you're only concerned with this. Debit bad debt expense, credit the allowance. That's your adjusting entry. That's all you're concerned with. Bottom line is you get a 12.8 as your allowance account. So we don't care as much about the allowance. And then the NRV is 112, 200. 112, 200. All right, so that one was great, everyone picked up on that. If you did not, make sure you understand why, that this is now the C is the correct answer. Yep.
At what time do you create a write-off?
Write-offs?
At what point in time do you create a write-off?
The write-offs, at whatever point the credit department determines the account will be uncollectible. Because at that point, you see, you're using an allowance now, and you don't necessarily know the exact accounts that are gonna go bad. But when you write the account off, it's a specific customer, and that's when it goes to collection.
And what's that journal entry?
The entry to write it off would be a debit to the allowance account, and credit to the accounts receivable. So on a specific, like it's $100 of this, and whatever the customer name is, specific customer, it comes off against the allowance. So the allowance is there as a, if you remember the allowance, think of the allowance as a provision or a cushion that you've got to use to absorb losses. There's no more expense. That's an income statement neutral, in other words, a balance sheet only adjustment or write-off.
And when I get paid, before I record, let's say, my cash increase on my accounts receivable, there's another journal entry between that.
All right, so hold on, so that's one. So now, that customer was written off. It has no change on the net realizable value. We won't change the amount. Next question.
Like, let's say you get paid again, I know that before I record cash and accounts receivable,
Right.
there's another transaction where you
Yeah.
have to put it back.
Right, so what we do is, let's say this customer pays you back, and you got a recovery. You reverse this entry. So you put the allowance back. So you restore the allowance account. You restore the allowance, you put the customer back. That would be their credit rating is now recovered. And then you have the cash,
Cash.
and then a cash receipt. Once again, there's no income statement effect on a subsequent recovery. What actually happens, by the way, is that there's no balance, there's no income statement effect. The entry really is the debit to cash and credit to the allowance. That's the net.
At the last point, it is a cash inflow.
That's the cash entry. Right, that's operating.
You said we're supplementing the account, so that's what you're
Because you're putting it back, because if I wrote your account off, you now have a negative credit rating. So what I do is I restore, you're now going to pay me, so the first step in repayment is to restore your credit on my books and put the allowance back, so now I need it. So I recovered that allowance, I recovered your account, and then I have to pay the collection. Now, you have to make this entry? No, you can just debit it, cash, and credit the allowance. Because the bottom line here is, your account was already gone anyway. So what if you did that? What if you debit cash, credit the allowance? What's wrong with that? Nothing in terms of debits and credits, nothing in terms of account balances, when you lose information. It's a loss of information, a transaction information.
You don't know where the cash came from.
That's right. Yeah, you don't know where it came from, you don't know the specific customer, back to my point before. The allowance is always against all receivables, not one receivable. Now you've got a specific customer that you're dealing with, so you need to be more careful in documenting the transaction. Because now, don't forget, this is going to go to a very micro or a very granular level in the company. So when we look topside on the financials, which you would look at as an auditor, you're just going to see the cash and the allowance account change, right? But the bottom line is internally, when we look at this customer, if you ever called up and said, well, you know, I want to buy something, well, no, you got bad credit, you didn't pay us, well, yes, I did. I mean, that's the idea, you've got to have that documented. Okay, good question. So that's the full complement of what could happen receivable transaction. Now I got another question for you. Last one, this one, number 6, this one is easy. Now I'm only going to give you 2 minutes, and you'll see why it's easy in a second, or easier. So let me give you the standard 2 minute. All right, so yeah, the answer would be C. Let's find out why we only got 58%. All right, what makes this one a little easier is because we have an opening balance here of 2.4 million. And it says you got a beginning balance in the allowance for bad debts of 120. But it gives you the ending balance already, and that's 212. Now, they told you that ending balance came from the aging. So, I mean, you already got it. It's just basically the 2188. You didn't have to do anything. This problem required nothing except subtracting the two numbers. And sometimes that happens on the CPA exam. From time to time, I help people while they're taking the exam, even after they graduate, they'll send an email or something and say, I can't figure this question out. Sometimes the easier they are, you're looking for something more difficult. So this one, that's all you had to do. But I could extend this. Of course, I wouldn't let you get away with that on the exam. I would ask for the adjustment. So the adjustment in this case was what, 92? Yeah, that's what a lot of you probably did. And I would extend that. So the entries are debit. The bad debt, credit the allowance. If you needed it, but again, answer is C. All right, so anything else on receivables? Anything else on receivables? It's not bad if you went through more of a detailed analysis there, but you didn't really have it. All right, so now we're going to move on. As I said, Module 3 is notes receivable. We covered enough of that simple interest in the review of Chapter 4. The next module, Module 4, we probably will circle back to that when we look at non-monetary exchanges. So let's go to number 5. And in Module 5, we're going to look at using receivables to secure immediate cash. So that means that how do you use the receivables to obtain cash? And we're going to focus more on factoring and securitization. You could also borrow and use receivables as collateral. So when you finance with the receivables, we talked about using receivables as collateral. You can have a secured borrowing where you can use the receivables as collateral, or you could sell the receivables. The two ways to use receivables in borrowing is either to assign specific accounts as collateral or pledge all of your receivables. So, for example, you go to the bank, you tell them you want an asset-based loan for, let's say, operating cycle purposes. Remember we went through the operating cycle? Well, you don't get your cash quickly enough, so now you need an asset-based loan. Assets are generally inventory and receivables that become your collateral. You could do one of two things. You could either pledge all of your receivables as collateral, or the bank might say, I want to come in and audit your receivables, and I only want to give you collateral for specific accounts. I want to know what accounts are there, and sometimes those accounts are actually not transferred, but the payment goes directly to a lockbox or goes directly to the bank that you borrowed from. So it really depends. So an assignment, specific accounts. When you do that, generally nothing happens because you still are responsible for those receivables, and all you need is a disclosure. Now remember, don't forget disclosures for exam purposes as well, but when you have an assignment or a secured borrowing, nothing happens except disclosure. Now, when you sell the receivables, the two ways to do it, one is securitization, and The other one is factoring. We're not going to do much on securitization in this course. It's becoming less popular today because of the financial crisis. But the way this would have worked is that you would have a financial institution let's say an investment bank, and you go to various companies. Go to AT&T, you would go to General Motors Financing, let's say mortgage, brokers, and you would buy their receivables. And you would buy high-quality receivables. You buy AT&T cell phone accounts. You would buy GMC loans, leases. You would buy mortgages. Where would you get the money to do this? You'd have debt holders. Debt holders would supply the cash. That cash would then go to the various companies. And where's the security? The receivables were security on that debt. As the receivables were collected, the receivables would pay off the principal plus the interest. Now, this was an ingenious way to do business, except when the economy crashed. When the economy crashed in 2008, 2009, mortgages went bad, cell phone bills weren't paid, people were driving around with trucks that were almost worthless when gas prices went up, right? So people didn't want these big vehicles anymore. So people were defaulting on these loans, and therefore the financial institutions couldn't pay off the debt holders and they defaulted. So that's what a securitization looks like. Extremely popular. We had people coming to talk to us about it at Rutgers saying it's the greatest thing since the invention of the wheel. Because of the following benefits. I mean, you could get multiple investors. You could get tons of investors to buy these asset-backed securities. In fact, when I was teaching at the investment banks, lots of my clients had asset-backed security units that would just handle these kind of securities. So these asset-backed debt instruments were securitized by those other receivables. And that was the security. Now, lower cost. You would have lower interest because you would tell me that these receivables are coming from the highest quality customers, right? So I don't have as much risk, so the interest rate was lower. And we had multiple investors. But here's the problem. Risk of non-collection, which we know, and here's the other problem. As a debt investor buying an asset-backed debt security, I don't really know the credit worthiness of those thousands of receivables that you're packaging into this debt security. So you would package hundreds and thousands of people's accounts into these securities. So it still happens, not as popular, obviously, but that is a securitization.
Can I apply all these terms to tax liens?
I'm sorry?
You know tax liens? Can I apply all those terms to tax liens? Like, because it's pretty much like the same thing where you're buying the person's debt and only if they pay and you recover your...
Yeah, it's similar to it. Yeah, we're going to see factoring too. It's going to be similar to that. Only factoring is different because it's a one-on-one. So I'm going to deal with one company, and I'm going to know those receivables. All right, so let's do that now. Let's look at the factoring. Factoring is where you sell the receivables directly to another individual or company, and this individual or company is known as a factor. A factor is a person that buys the receivables. This used to be very popular in retail before the widespread use of credit cards. You can factor or sell your receivables with or without recourse. When it's with recourse, the buyer can come after you for non-collection. When it's without recourse, you have no other, as the seller, you have no other responsibility. The question is whether or not should you record this as a sale, or should you record it as a secured borrowing transaction? So in order to record it as a sale, and here's where you've got to understand. So here comes the memorization, in a sense, or remembering. In order for receivables, whether with or without recourse, and when there is with recourse, we say that it is continuing involvement. So if you sell your receivables with recourse, you've got continuing involvement. If it is to be a sale, you have to meet all three conditions. Here's the theory, here's the multiple choice kind of questions that you're going to be asked. And that is, what are the three conditions? Well, number one, the receivables have to be isolated from the transferor or the seller, so that the receivables have to be isolated from the person selling the receivables. The buyer, the transferee, has the right to pledge or exchange those receivables. And the third is that the transferor, the seller, does not control the receivables, and it means that the seller cannot repurchase them or require that you sell them back. The whole idea, again, all three must be met, but the whole idea is very much like the revenue recognition standard you're going to see next semester. In order to recognize revenue, or here, in order to recognize a sale, because is this revenue recognition? Yeah, if you're going to record a sale, it's part of revenue rec. So going to chapter 8 next semester, you're going to see that the entire model, the theoretical model for a sale, is driven on control. The buyer has to control the asset. Once that happens, revenue can be recognized. So this is simply saying with three conditions, and this is where a lot of people start saying, actually, maybe I shouldn't engage in accounting, because it's a bunch of rules, lots of rules, a lot of conditions. Meet these three, meet one of those two, and but here you got all three must be met. If all three conditions are not met, then you got a secured borrower. Now I thought I'd give you a flow chart, make it a visual, make it a little easier, I hope, to understand. So transfer receivables, again, the same idea, different terminology. The way it's going to work is that if the three conditions are met, first question is there continuing involvement? The question is there recourse? Continuing involvement means recourse. So is there recourse? If there is recourse, whether or not there's recourse, it'll be recorded as a sale. We use something known as a financial components approach because we have to recognize the receivables coming off the books. You'll see this in a journal entry in a moment. Recognize the assets you receive from the factor and the liability. The liability here is going to be an estimated recourse obligation. So you're going to need to estimate how much you think you may be able to be liable for if the accounts are uncollectible. So that liability is an estimated recourse liability. And then you record the gain or loss on the sale. If there's no recourse or no continuing involvement, you just reduce the receivables, record the gain or loss, and of course the assets that come in as well. And if you don't meet all three conditions, so if you violate any one of the three, so perfect example of what the CPA exam was trying to show you on that grid. Memorization. So I'm going to give you a scenario, did you meet the three conditions? So now you've got through 20%. Then the next part is the application. Well, does it have continuing involvement or not? If it violates, by the way, and it could happen, if you violate one of the three conditions, you just record it as a secured borrowing transaction, and you record it as a regular debit to cash, credit notes payable kind of thing. and that's it. So if you don't meet the conditions, it's the secured borrowing, and the receivables are set up as your collateral. Now, let's put this into practice. So that's the concept. Now the practice. So let's do the illustration. And it tells you that we've got Houston Corporation is going to factor $175,000 of accounts receivable with Beaumont Financing Incorporated. The receivables records are actually transferred. So I said sometimes that happens where the collection goes directly to the buyer and they have the records, and it's on August 15th of 2020. Now, some terminology. The financing company assesses a finance charge of 2% of the receivables. It also has like a compensating balance. They're going to hold back 4% for additional security. So even though you may transfer those receivables without or with recourse, they have a holdback or a compensating balance. And that's more or additional protection for the buyer. Now, that means you're going to get 94% of the receivable balance. 2% is a loss or an expense, 4% is a holdback, which you'll see if the receivables are collected. So, in the requirements, I would ask you, this is a qualitative question, I want to know the 3 conditions that you'd have to meet for this to be a sale. And secondly, if you do meet the conditions, what's the entry to record the sale? And if there is recourse, what's the recourse liability? I have to give you that number. So I'm going to tell you that the recourse obligation is going to be $2,000. All right, so the first part, again, is memorization, pretty much. What are the 3 conditions? Well, the assets are that you transfer are put beyond the reach or isolated from the seller. The buyer has the right to exchange or pledge those receivables. And third, the control is transferred over to the buyer. Now, that means that, for the most part, that the seller can't force you to sell them back after a certain point in time, or you can't force the seller, or the buyer rather, to sell them back to you. That could happen. You could have an under-the-table deal or part of the contract that say, after 6 months, I want to buy them back. That is not a sale. That actually is a secured borrowing transaction where you take back the collateral, let's say after the loan is paid, pretty much. Right? So you transfer with control. You have to transfer with control. Now, I'm going to show you a couple of things that we're going to do. First of all, we got to figure out how much we're going to walk away from this deal with, and that's the net proceeds. So let's just see how this is going to work. First of all, how much cash do you get? Like I said before, you're going to walk out of the financial institution or the factor with 94%. So the total receivables are 100%. The holdback, the reserve, or the compensating balance is 4%, and the finance charge is 2%. So that's 164.5. However, there's a very important point. That holdback or that compensating balance is an asset. It's a receivable. It's due from the factor. So this is a receivable. This amount is a receivable. Now, again, although it is not technically a compensating balance, it operates like a compensating balance. If you remember, compensating balances are still part of current assets or long-term assets. They're still assets. Yeah.
You said the holdback is an asset?
Yeah.
Well, the
Because
holdback,
it's like a deposit you're leaving with the factor.
but it's going to be returned at the end of
It will be returned if all those receivables are collected.
So shouldn't it be a liability?
No, because you've already, it's almost like a prepaid. So I'm giving you the money, you're holding it. If all my receivables are paid, you give me back the money. So it's like a deposit. Now, does the factor have a liability? Yes. So think of it like a deposit. So if I'm dealing with your company, and let's say and this happens a lot with companies that deliver liquid products like chemicals. So you now deliver those chemicals to me. I've got your containers. I've got to give you a deposit for those containers. I've got an asset called deposits because I'm holding those drums. You've got a liability because you've got to give me back that money once I return the containers. So it's the same thing here. Once those receivables are paid, it is not a deposit. Don't put deposit on the exam. I'm giving you an analogy. You've got the money. You've got to give it back to me when those receivables are fully collected. So right now it's a receivable. And that means your total assets are cash plus the receivable of 171.5 minus the liability goes in net proceeds. This is known as the asset liability approach. Now, I need to calculate the loss. The loss can be calculated in two ways. The recourse obligation is a loss. That's where the liability comes in. So you are selling those receivables with recourse, meaning that you are responsible. We estimate that to be $2,000. The finance charge is 2% of the balance. That's $3,500. That's $55. Easiest way to get it, I think, but maybe a more theoretically correct way, more intuitive way to get the loss. The receivables are coming off your books at 175. The net assets you get are 160.95, making it like a sale of any asset. If the asset's on your books for 175 and you get net proceeds of 160.95, your loss is 5,500. The loss is 5,500. So your total loss on the transaction is 55. All right, so you're selling the receivables with recourse, and there's a holdback or a reserve. There's a lot of ways you can get the numbers, but you have to find out the net proceeds, the due from the factor, and the total loss. Now, before we do the entry, any questions on the transaction? So you're selling the receivables for a price that is going to have 98% coming to you, but there's a holdback of 4%.
The 5,500 is going to the person receiving the receivables, right?
No, it's the seller, it's the person selling, it's a loss on sale. You sell those receivables at a loss. The person buying doesn't have a gain or loss right now, they only earn the finance charge.
So where is the 5,500 from?
This is the person that buys it earns 3,500. If everything's collected, that's all they earn. If there is some default, they would either keep the holdback, or on top of that, you got a recourse obligation that you have to pay, and they may earn that as well. But we're talking about the seller. So the person that's selling it is going to pay the finance charge of $3,500 and estimates $2,000. So we have to accrue a total of $5,500 in losses. But right now, it's a good question. Right now, the person that's buying them, their only income is going to be finance charge.
And so using the ultimate computation, avoid using the finance charge we want.
Oh, yeah. Now, I'm just showing you, what I like to do is show you more than one way to calculate it because of a lot of things. One, what if you don't have all the information? And I think this is a lot more logical because it's, look, this is what I sold. I sold an asset that is on my books at 175. This is what I received. The difference is the loss. You're not going to receive more in this case. It's always going to be a loss because of the factoring cost. All right, other questions before we do the entry? Yeah.
So could you use that as your journal entry?
I'm sorry?
Could you use that as your journal entry?
We got to make the entry. No, that's not an entry. We got to put it for debit and credit. That's the calculation. So once we make the calculation, now we can do the entry. So that I'm going to show you two entries first, and then a combined entry. You can do it either way. In the first case, I'm going to assume, and I like to show you two entries because when you combine them, you lose information. First entry is ignoring the recourse obligation. So you debit cash for the amount you receive. So you're going to get 164.5. Remember, there's a 2% finance charge, a 4% holdback. You're only getting 94% of the cash. 164.5. The due from factor, like the deposit, right? You've got a receivable from the factor. You debit the loss, the finance charge, and you take the receivables off the books. You take the receivables off the books, it's just selling the receivables. Then, if I tell you there is recourse built in, you have to estimate by accounting standards. We're required to ask our clients to estimate a recourse liability. The recourse liability will be given to you. It's estimated at $2,000 in this case. So we debit the loss on sale of receivables and credit the recourse obligation. That is a liability.